Hello and welcome. In this lecture video, we're going to be talking about the effect of underapplied or overapplied overhead on net income. We'll also do some extra practice problems, and then we'll also summarize some of the journal entries associated with job order costing. So if we look at underapplied overhead, remember the journal entry would be to debit cost of goods sold and then credit manufacturing overhead if we close it all out to cost of goods sold. Or if we allocate it, which means it's material, debit work in process, debit finished goods, debit cost of goods sold, and then credit manufacturing overhead. As cost of goods sold goes up, cost of goods sold is an additional expense. So that means expenses are going up. As expenses go up, net income goes down. On the other hand, if we have overapplied, that means we would debit manufacturing overhead and credit cost of goods sold if we close it all out to cost of goods sold. Or if we allocate it, it would be a debit to overhead, credit WIP, credit finished goods, and then credit cost of goods sold. In either case, any decrease to cost of goods sold, because we're crediting cost of goods sold, that decreases cost of goods sold. Cost of goods sold is an expense, so therefore we are decreasing expenses. As expenses go down, cost of goods sold goes down, expenses go down, income goes up. So if we look at this quick check problems, what effect will overapplied overhead have on a company's net operating income? Well, if we look at overapplied overhead, that means we will debit manufacturing overhead and credit cost of goods sold in either situation. It's just that here we would credit cost of goods sold more than we would here, because only some of it goes to cost of goods sold versus all of it here. In either situation, cost of goods sold will go down. That means net income will go up. Okay? So on the next page, I have a practice problem, and I want you to do this practice problem. I want you to pause the lecture video and do this practice problem, and then we will check it. Okay, so let's see how you did. So Henderson Company estimates that overhead will be $260, direct labor costs will be $650. That gives me a rate overhead divided by base of 0.4. This is telling you have 40 cents of overhead for every direct labor dollar. Henderson had direct labor costs of $80,000. How much overhead would be applied? Take the rate times the $80,000. $32,000 is overhead applied. What's the journal entry? Debit WIP, credit overhead. That's always the journal entry to apply overhead. If actual overhead is 36, applied is 32, it's underapplied because actual is more than applied, or applied is less than actual by $4,000, and then credit it, then close it out to cost of goods sold. Debit to cost of goods sold, credit to manufacturing overhead. The reason why that would be, because remember we have our T account here for manufacturing overhead. We have our $36,000 right there, $32,000 worth of applied. That means you got to put $4,000 right there of overhead on the credit side, and then we would debit cost of goods sold. Then the thing to keep in mind is that you debit cost of goods sold by $4,000. Net income would then go down by $4,000 because cost of goods sold is going up, income goes down. Okay? So in terms of job order costing with service companies, that's used quite frequently, as I was saying about repair shops, also hospitals, law firms, consulting companies, or even shipbuilders. Those are all examples of job order costing. It's just that service companies don't make a product. They sell the time of their employees. So like an IT consulting company would be another service company. An automobile repair shop. Those are service companies, okay? But as I was saying in one of the first lecture videos for the chapter, the patient, client, or your car is the job. And so we keep track of, or that company keeps track of, materials and labor and overhead for each job, or in this case, it could be your car, or if you go see a lawyer, you're the client, or if you go to the doctor, you're the patient. They keep track of materials, labor, and then overhead for you as the patient, you as the client, or your car. Okay? As I was saying right over here, this last bullet point, in the case of repair shops, they may not show you the overhead because what they do is they mark up their labor to cover their overhead and to also make a profit. Okay. In terms of a summary of the journal entries, remember to purchase materials, debit raw materials, credit cash, or credit accounts payable. To issue materials to production, remember debit WIP, debit manufacturing overhead, credit raw materials. Labor costs, debit WIP, debit overhead for indirect labor, credit wages payable. Other actual, debit overhead, and then remember we had the credit to accumulated depreciation or credit to prepaid insurance. Okay. Apply overhead, debit WIP, credit overhead. When jobs are completed, as we did earlier, debit finished goods, credit work in process. And then when we sell it, this is a little bit confusing. Remember we have accounts receivable or cash, and then sales. And then the other thing is to recognize cost of goods sold, debit cost of goods sold, and credit finished goods. It's the same thing. I just think this way, separating it out between the sales and then the cost of goods sold makes it a little bit easier to understand. Okay. So here's what I want you to do is I want you to pause the lecture video and I want you to do this problem, and then these problems all on page 136, which then spill over to page 137. I want you to pause the lecture video and do these problems and then restart the lecture video and then we'll check your work. Okay? Okay, so let's see how you did. First one is, during the month of August, our company applied overhead using a rate of 80 cents per hour. This is our predetermined overhead rate. Direct labor was $138, estimated overhead $112,800. Actual overhead is all these items. How much will they debit overhead? Well, the key is you have to remember that the debit to overhead is the actual overhead. Okay, that's the actual overhead. So B is the right answer. Actuals debited, MOH, which manufacturing overhead, which would be applied, which is our 138 times 0.8, which would be 110,400. That would be credited. Okay, that would be credited. When we look over a job order costing system, is likely to be used by a caterer. And this, a caterer, if you think about that, they have very different jobs. They have, maybe one party that they have to cater has 100 people. The other one has 20 people. And the parties want different types of food. So it's very different. And so it would be also done to customer specifications, and they would track the costs, the food and the labor costs by the client. So a caterer is the best option right there. Our company applies overhead to each window cleaning job it provides based upon direct labor hours. Information concerning manufacturing overhead and labor for July is as follows. We have our estimated labor, 5,000 hours, and then we have our estimated overhead. It's estimated overhead divided by estimated allocation base, and our allocation base is direct labor hours, and that's 5,000 hours right there. So we take our 269,800 divided by our 5,000, gives us our 53.96 per hour right there. Okay. Our next company determined the rate to apply overhead on direct labor hours would be $5.40, and based on machine hours, 420. Job 664 used $26 of direct materials, 2.5 machine hours, and 4 hours of direct labor at a cost of $14 per hour. What is the total cost? That's what I'm asking for. What's the total cost? And so you have to break that down between materials, labor, and overhead. And we're told $26 of materials, 4 hours at $14 an hour gives us $56 of direct labor. And then if we apply overhead on the basis of machine hours, we take that 2.5 machine hours times our rate of $4.20 per machine hour, gives us $10.50 for manufacturing overhead. This plus this plus this gives us our $92.50, which is the total cost of the job. Okay. Our next one, our wedding planners applied overhead using job order costing at a rate of $3.25 per hour. Estimated hours, total 220. Estimated overhead was 715. Actual direct labor hours are 215, and actual overhead was 702. Determine the amount of under or over applied. So the first thing is we're given our actual overhead right there, and we have to figure out what is our applied overhead. Well, we take the amount of allocation base actually used, which is 215 hours, times our predetermined overhead rate of $3.25 per hour, gives us $698,750 of applied overhead. And then we subtract that from our actual overhead, and that gives us $3,250, and it's underapplied because our applied is less than our actual overhead by $3,250. Our final question right over here, our company uses job order costing for making playground sets. The company incurred the following costs during March: materials, labor, applied overhead, and then actual overhead. And you can tell right off the bat, you can see I have my T account down here with manufacturing overhead. Here is the actual, here is the applied, and that's given to you right there. What is the journal entry of either the under or over applied if we close it out to cost of goods sold, which we would naturally do at year end? Okay, or in this case, they're doing it in March. So we have our 20,000, which is our actual, our 18,000, which is our applied. It's $2,000 under applied because applied is less than actual by $2,000. Our journal entry would be therefore debit cost of goods sold and then credit manufacturing overhead. Because if I put that $2,000 right there, now I have 20,000 and I have 20,000. 20 minus 20 is 0. The balance in manufacturing overhead is 0, and it has been closed out to cost of goods sold. Remember that this debit to cost of goods sold increases cost of goods sold, which increases expenses during March, and therefore this debit to cost of goods sold increases expenses. Expenses go up. Income for our company would then go down after doing this journal entry. Okay? So that concludes this lecture video and the lecture videos for this chapter. Thank you so much.